Imagine you have a friend, let's call him Ken, who lets you borrow money for free. You take Ken's money and bet it on a football game who pays you out huge winnings. And then we try to do it again. That's easy cash, right? Suddenly, Ken calls you out and says, "Hey, I need my money back right now. And I'm also charging you interest starting today." You don't have those money because they're all tied up in those bets. So you have to panic sell the bets, even the winning ones, just to pay Ken's back. That is exactly what happened to the global stock market the moment when Japan raised rates. Hi everyone, welcome back to the SIG podcast, where we talk all things SIG about economy. This podcast is hosted by the Student Investment Club, and I'm your host, Roberto Cacaci. Last time, we talked about the Federal Reserve being the Kardashian of macroeconomics, but today, we're looking east. We talk about Japan. If the Fed is the drama queen, the Bank of Japan has been the quiet friend who suddenly decided to flip the table at the dinner party. And today, we talk about the Japanese carry trade. I know it sounds technical, but let's break it down and try to make it digestible. First, what is the carry trade? Think of it as the ultimate financial hack or infinite money glitch that hedge fund has been used for decades. So here's how it works. For years, Japan has had interest at 0% or even negative. That means that borrowing Japanese yen were basically free. So investor will borrow massive amount in Japanese yen, convert it to dollars, and go buy assets that actually pay money, like US stocks, Mexican bonds, Nvidia shares, you name it. It's like taking a 0% interest loan to buy a high yield dividend stock. You pocket the difference. It's free money, right? And the scale of this trade, we're talking about trillions of dollars. Here's the red flag. This trade only works if the yen stays cheap and the Japanese interest rate stays low. But in the last few weeks, the vibe completely shifted. The Bank of Japan decided to raise interest to about 0.25%. I know, 0.25% sounds like nothing, right? But in the world of free money, that is a huge shock. At the same time, the Federal Reserve Bank is cutting interest rate. So what is happening is that the gap between cheap yen and expensive dollar is suddenly shrinking. Suddenly, the free loan isn't free anymore. The yen started getting stronger, and everyone who borrowed yen to buy stocks started losing money instead of making money. So they got hit with what we call, in financial terms, a margin call. To pay back those loans in yen, big investors had to sell their winning asset immediately. And that's why, towards the end of November, we saw a massive sell-off from US equities to crypto. And so why is this important for things happening right now, specifically for the US economy? Japan isn't just a normal trader. We can call them like the ATM of the world. And that's because for 40 years, they have been the biggest buyer of US debt, the so-called treasury bonds. They've been parking their surplus cash in American debt, which helped keep our interest rates low. But now, Japanese investors have actually a reason to keep their own money at home because their own interests are rising. So if Japan stops buying American debt or even worse, selling it, US government has only one option, which is to pay a higher interest to attract different buyers. And we know the drill. If treasury yields goes up, everything else gets more expensive. Mortgages, car loans, credit card interest rates, they all climb. So what is the takeaway for us students? First, volatility is the new normal. The days of easy money when stocks just goes up because interest rates are zero are fading. Second, keep an eye on the 10 years treasury yield. If that spikes because Japan pulls back, job market and student refinancing loans might get tougher. As one analyst put it, the global financial system has been using Japan as a cheap credit card for over 40 years. But now, suddenly, Japan decided to cut up the card. So thank you for listening to the SIG podcast. Watch the yen, watch the yields, and as always, stay curious, stay informed, and stay SIG.